All right, so let's chat about something very important that I've already announced on Friday's Finest, and you've probably seen other lenders talk about it, but it's real important, and that happens to be the change in FHA. Is anybody here, boy, I got a lot of junk on my hands. Is anybody here not aware of the change with FHA's mortgage insurance premium? So everybody's heard about it, at least heard about it. Okay, good. So here's the impact. Back in 2012, after the crisis, the FHA insurance program, HUD's insurance program, was decimated. So they had to do two things. One, they had to rebuild it, and number two, they had to find a way to make it sustainable. They never predicted anything like what happened in 2007, 8, 9, 10, 11 was going to happen. So FHA was devastated. So what they did a twofold increase. One, they changed the upfront MIP to what you know today as the standard FHA upfront MIP, 1.75% of the loan amount. Makes no difference if you put down 3.5%, you put down 20%. The upfront is 1.75. Now, in all the years I've been doing this, which as you know has been a whole bunch, I've never had a client that did not finance the MIP. So it's always added on to the loan. It doesn't have to be, but my experience is it always is. Now, the second thing they did is they changed the monthly premium and raised it so that the multiplier was 0.0085. I'll show you how that works in a moment. That's not going to work. There we go. 0.0085. So how the monthly, well, anyway, let me go back to the story. So they raised it up in 2012. In 2016, one of Obama's last acts was to reduce the upfront premium and make an attempt to reduce the monthly. So that was one of the last acts that he did, and it never took place. And when the new administration came in, they killed it completely. They said there's no way that the insurance is going to be okay. We've got to keep it more sustainable, so they killed it. So now here we are 7 years later, and they're finally making one change. The upfront is still 1.75, but they had bipartisan approval to change the monthly from 0.0085 to 0.0055, or in some cases 0.005. Now, you don't have to remember all of this. The lender is responsible to remember it, but just that there's two different ones. The big difference between here and here is the down payment. Depending how much money you put down, you may be able to get away with 0.005. As you can tell, it doesn't make much difference. So this is the big change. I mean, we've been going 11 years with the higher premiums for FHA. The reason this is significant is the amount, this amount here, this difference, can make a huge difference on what a buyer can qualify for. Because now, and let's face it, a lot of FHA buyers are pushing the max when it comes to their debt-to-income ratios. They're coming in at 53, 54, 55, 56. And that might get them a home for $215,000. Now all of a sudden, this changes, and now maybe we can take them to 2.25, 230. And as you know, probably better than I do, but a home for $230,000 or $235,000 can be much nicer than a home for $215,000. So that's why this is significant. So let's take a look at a couple of examples. First, I want to explain, this is how it works, okay? It's actually quite simple, but here's how you calculate the monthly. You take what we call the base loan amount. So let's make the numbers easy. Take 200,000, and loan amount is times 96.5. All right, base loan amount. So 200,000 times 0.965 It means I have a loan amount of $193,000. That's your base loan amount. Now bear in mind, the actual loan amount is going to be 1.75% higher than that, right? Because of the upfront. But we take the 193, come on, pen work, times, we're going to multiply that times this number, 0.0085. And that arrives at, that's 1640.5. So that's the annual MIP. So now what we do is we divide that by 12. That gives us, let's round it up to 131 to 137. So we divide this by 12. And we're going to come up with $137 a month. So on a $200,000 loan for 3.5% down, and the other thing, how long does that stay in place if you keep that loan? What's that? For FHA, the current policy, how long does your monthly premium stay in place? Forever, exactly. It's called life of loan. Big change, all right? So we got this, let's just do this. Let's take 193,000. Now we're going to multiply times 0.0055. Let's see what that difference is. That's 1061.50. So the annual, now we're going to divide that by 12. We'll call it 80, let's call it $89. Round it up, because I did round it up the other one. Look at that difference in monthly payment. I don't know about you, but to me, 140 versus 90, that's $50 difference. That's a huge difference in somebody's ability to be able to buy. Because now I can take that $50 and I can apply that to their principal and interest. Or I can take that $50, apply it to the tax, whatever it is. But it's going to make a $50 difference on their ability to be able to buy a house. Here's the other difference. This is life of loan. This is 11 years. And if they put down 5% instead of 3.5, it's still 0.055, but it ends in fewer years. I forget what it was exactly. So that there's changes in the way this looks. They're trying to make it, one, they want to qualify more people, which is exactly what they need to do. The second thing they want to do is they want to make it more competitive to conventional, because conventional has recently made some changes, so they're trying to make it more. This is huge, this difference. And if you're wondering about the validity or possibility, will FHA's insurance be able to continue to maintain if the market changes? The standard, HUD is required, excuse me, by their charter, they have to maintain a 2% reserve or above a 2% reserve. Their current reserve is at 11%. So that's why it was bipartisan that they could actually bring it down, change that number, and still be able to maintain well over the 2%, even if we do have any kind of some kind of an unexpected crisis. And I use the word unexpected because there is no expectation that we're in any kind of a crisis situation, or they would have never done this. So everybody's leaning toward things are changing. Now, personally, I'd love to see the 1.5 change. I'd love to see that down to maybe 1.75, excuse me. I'd like to see that down to 1.25, maybe even 1%. Again, it just makes it a little bit more feasible for people to to qualify. This is a big difference. Questions on this? Now, bear in mind, this goes into effect on March 20th, but the way all lenders are doing it, if you take a new loan right now, it's not going to close until after the 20th. And so the way that HUD set this up, thank goodness they did this, they set it up for loans that are being delivered to Ginnie Mae or being delivered to HUD for insurance. As long as that delivery comes in after the 20th of March, we can use the new numbers. So everybody that goes under contract now, they'll be able to take advantage of this if they're doing FHA.
So if I write a contract this week?
If you write a contract this week, and you got to make sure, if it's me, you don't have to worry about it, but if it's a different lender, you make sure that they're quoting them this, because that's what it should be. The only way it wouldn't be that is if it were to close before the 20th of March, which probably isn't going to happen. Today's the 6th.
Yeah.
So in all likelihood, it's going to close after 20th. So yes, they make sure they use this. Now, they may have been pre-approved under this, but this will be their number. And they will be very happy to find out that their monthly payment's gone down. This morning, I was working with a client that I've been working with for quite some time, and I had them pre-approved up to $307,000. And the only way they made 307 was because the property taxes for 2022 on this particular property they weren't real low, but they were lower than what you would normally have. So they qualified at 307. That happened, that approval was issued 2 weeks ago. So now this weekend they were going out and they wanted to find a new house, but they can't find, the house they wanted at 307 is not available. So they wanted to go up. Well, fortunately, what we were able to do is go to this. Now the taxes on the new property are going to be more expensive, but they went from 307 to 315. And if it wouldn't have been for the tax situation, probably could have took them up all the way to 325. So it made a very, very healthy difference for people that are now, they're kind of stuck with FHA. I shouldn't even say it's not stuck, it's a good loan. But this just makes it that much more palatable.
So if we already have an approval for kicks and giggles 280, could that number be stretched a little bit further?
If they were pre-approved with this, now it's going to be this. Absolutely, you can go further. You absolutely, that's the purpose of this huddle session. Every FHA buyer that you have on video or here, make sure that you're talking to them or that the lender's talking to them about this. This makes a nice big difference for them. Now, I'm going to mention one other thing that I'm going to talk about next week, and that is the changes with Fannie Mae and Freddie Mac on their interest rates, because they've made some changes on the way they calculate out interest rates. It used to be if you were above 760 and above, everybody got this. If you were 761 and 801, you got the same rate. Not anymore. Now they put another break in there, 780. So 781 and above gets all the same rate, but if you go below 780, now you're going to get a little bit different rate than if you were at 781. So they've made some changes. They've also made some changes on the lower end. If you were at 660, the interest rate was this, now it's going to actually be just a tad better. And now they claim they're doing that so that they can get more people in the homes. What they're really doing is competing with FHA a little bit. So, but honestly, still, even at that, 660, you're going to get an FHA loan. And now that FHA's made this change, that can make a big difference. All right, any questions? So next week we'll talk about the changes in rates for Fannie, and I'll actually have a chart for you that you'll be able to look at. You don't have to remember it all, but at least you'll know that it's out there, okay? Yes, Ms. Jasleen.
Realistically, I have people that keep asking me, are we going to ever see rates as low as 2 and 3% again?
All right, what a great question. Are we ever going to see rates as low as, 2.75 again, all right? In my opinion, well, let's put it this way. In my lifetime, it's not going to happen.
Okay.
All right? But I'm old. So In Nicole's lifetime, it might happen. I mean, we don't know. Now, let's face it. I've been, as you know, I've been doing this 33 years. I never saw rates in the 2s, ever. So what happened that drove rates into this is the way I handle it with a customer, because they'll ask me that question. And I'll say, well, in 33 years, I've never seen it below 3% until something occurred. What was that occurrence? COVID. But now COVID wasn't the reason the rates went down there. COVID caused the Fed to take action on them buying the mortgage-backed securities. That's what drove the rates down. So the combination of the insecurity in the markets, everybody was buying bonds, the investors were buying bonds, and the Fed guaranteeing that they're going to buy so much of this, dropped rates to historic lows. Will we ever see that again? Honestly, I hope not. Not because I don't want to see people get those kind of rates, but it took an event like COVID to drive the Fed to do what it did in order to drive rates that low. So we don't need that. In 2013, interest rates, we actually had interest rates at about 3.5. In 2016, we had rates in the mid-3s. So without having a COVID situation, we can still have rates below 4%. Now again, economic factors get in the way and change things, but I don't think we'll be below 3. Again, like I said, not in my lifetime, only in Nicole's. But, I think that in practicality, will we ever see rates again below 4? I absolutely think we will. Now, do I think that's going to happen in the next year? No. But who cares? If we can get down below 5 right now, oh my gosh, what a blessing that would be. And I think that could happen in the next 12 to 15 months. All right? Does that help?
Yeah, I was just asking because when I was watching CNN this morning, they were talking about the Fed changing the interest rates, and I can't remember the lady's name, but she was like, the medicine they're dishing out is not working. Credit card payments are at an all-time high, their rates are higher, and the mortgage rates, they're higher, and now everybody's scared to buy a house. She was making an argument. Raising these rates is not doing what they intended it to do.
All right, whoever it was, does not understand what they're saying, because the Fed started raising rates in March of 2022. And when the Fed started raising rates, within a couple of 3 months, inflation started coming down. Inflation has come down every single month since June, including last month. Now, what changed last month? Because overall inflation went down 1/10 of 1 point, which is not enough to shake the markets. It actually shook the markets the wrong way. What changed was called the PCE. That came out about 2 weeks ago. That's the consumers purchasing index. In other words, consumers, it goes along with inflation. What's their expectation? What are they spending money on? What's their willing to spend? January went through the roof. So inflation has been coming down, and it's going to keep coming down. So that's why when you heard that lady doesn't know what they're talking about. The Fed's actions are helping. What happened in January is that the consumer said, I don't care, I'm still going to go out and spend more money. If the consumers were to continue to do that, she might have a point. But that's not going to happen because the Fed's going to raise rates again this week, or next week, when they raise the rates. All right, it's going to put some more fear into consumers, and they're going to back off. You know what the number one thing was that actually people started spending more money on in January? This just freaked me out when I read this. Cars. Interest rates on cars have gone up, and yet people bought them. Why did people buy them? Did you ever look at the difference in payment at a 1.99% payment and a 3.99% payment on a car? The payment difference is minuscule. It does not move the needle on someone's living. What changes are credit cards. That'll kill you. Because even though the balance isn't real high, you're used to paying $100 a month, and all of a sudden that $100 a month is now mostly interest, because the interest went from 15 to 18% or some stupid number like that. HELOCs. Nobody's getting HELOCs like they were. This is what I'm saying. The lady doesn't know what she's talking about. HELOCs were, what do people use HELOCs for? Home equity lines of credit. What do they use them for? For renovation. They use them to buy things, right? HELOC rates have gone from 3.5 to 8.25 in 1 year. If you have a 50 or 60 or 70 or $100,000 HELOC and your interest rate went from 3.5 to 8.25, that's a big monthly difference. So that lady doesn't know what she's talking about. The interest rate that the Fed's doing has been working. We had a blip in the month of January. Now, everything is pointing toward when the March number comes out for February in about a week, then you're going to see it's going to look better. The numbers are all changing. My personal prediction is long-term interest rates are going to probably take a nice dip next month. Not huge, but a nice one. Again, back to May 10th. I think by May 10th, we're going to see a big dip. So the Fed keeps raising rates. I've been saying this ever since the Fed started raising rates. Keep raising rates. Don't stop raising rates. Maybe not 3/4, maybe not a half. Let's just do a quarter, but keep raising that rate, because that is going to slow down consumer spending. We slow that down, it drives inflation down. And if that keeps happening, interest rates are going to get better. There's no question. Long-term mortgage rates. HELOCs won't. Okay? Thanks, everybody.